Hello, and welcome. Today, we're diving into the modern world of central banking. Central banks face tough challenges, like low inflation or interest rates stuck near zero. This means their old playbook of just adjusting short-term rates isn't always enough. So they've developed new tools. We'll explore three key ones: quantitative easing, or QE, its opposite, quantitative tightening, or QT, and forward guidance. Understanding these helps us see how policymakers try to keep our economy stable and growing. First up, quantitative easing, QE. What is it? Essentially, it's when a central bank buys assets, usually government bonds, from commercial banks. The main aim isn't just fiddling with short-term rates, especially if they're already near zero. It's about influencing longer-term rates and boosting the money supply. Here's how it works. The central bank creates new digital money to buy these assets. This floods the banking system with cash, or liquidity, making banks more willing to lend money. By buying lots of long-term bonds, the central bank pushes their prices up and their yields, or interest rates, down. Lower long-term borrowing costs hopefully encourage businesses and people to invest and spend more. Also, institutions that sell assets to the central bank get cash, which they might invest elsewhere, like in stocks, giving the economy another nudge. QE is typically used during major economic slumps or when deflation is a threat, trying to boost demand and hit inflation targets. Now the flip side, quantitative tightening, or QT. This is the process of unwinding QE. The central bank shrinks the large balance sheet it built up during QE. It signals a return to more normal policy as the economy improves or inflation rises. How does QT work? One way is passive. The central bank simply lets the assets it holds mature and doesn't reinvest the money. This slowly drains cash from the system. A more active method is selling assets back into the market before they mature. This is seen as a stronger tightening move. QT generally does the opposite of QE. It removes liquidity and can push longer-term interest rates up. The goal is usually to control inflation without stalling economic growth. It requires careful handling. Many central banks have been using QT recently to tackle the inflation that followed the pandemic. Finally, let's talk about forward guidance. This isn't about buying or selling assets. It's about communication. It's how central banks tell markets and the public what they plan to do with monetary policy in the future. Think of it as managing expectations about interest rates, QE or QT. How does it help? By clearly stating future plans, perhaps linking them to economic conditions, like inflation reaching a certain level, or setting a time frame. The central bank influences decisions made today. If a central bank says rates will stay low until inflation hits 2%, businesses might feel more confident borrowing and investing right now. Forward guidance makes other tools, like QE, work better. Knowing rates will stay low for a long time reinforces the stimulus from asset purchases. Likewise, clear communication about QT can prevent markets from panicking. But forward guidance only works if the central bank is credible and clear. It reduces uncertainty and helps guide the economy. So QE, QT, and forward guidance are crucial parts of the modern central banker's toolkit. They're often used together. QE might come with forward guidance promising low rates for longer. Starting QT needs careful forward guidance to smooth the transition. While powerful, these tools aren't perfect. It's hard to know their exact impact, and there are debates about long-term effects like asset bubbles or inequality. But in a complex world, especially when traditional interest rate levers are limited, QE, QT, and forward guidance give central banks vital options to manage the economy. Careful use and clear communication are key. Thanks for listening.